The situation in China is much bigger than we have been told. I think it's important to understand the relationship between China and the US and what has happened here. The first thing I want to look at is the China credit, a particular indicator that is extremely accurate and important, something that I had highlighted earlier in the year. The second thing is the risks. Risks are being taken today, of course. Why? Federal Reserve, central banks, easy monetary policies, and how that has impacted the economy and the markets as well. The third thing is the overwhelming status of today's situation, whether that's for the small family farms, whether that's the inflationary pressures people are feeling, food prices, and so much more. All of that to get into, let's begin. First, I need to begin by showing you what's happening in China right now. Industrial production, retail sales, fixed asset investment, property investment, the growth is slowing down. This is important to note because you can see right now at this time, there was such a surge, just like many other countries. Yes, everything is growing, but now that growth is slowing down. What's happening though in the financial sector? In the banking sector, well, you can see the China credit impulse 12-month net change at levels we haven't seen since 2011. And you might ask yourself, if you're new to the channel, what is the China credit impulse? What does this even mean? Well, essentially, just to simplify it, it's the amount of money being lent out into the banking, through the banking system. And that gives you an idea of what's going to happen down the line. And this has been extremely accurate. It's always going to notify you well in advance. I brought out these videos back in April of 2021 saying that we would have slower growth based on this particular indicator, and that has clearly shown to be the case. You look at where we were back in April compared to today, and that's obvious. But you can also see that there are factors like less stimulus being given out. And now we have the Federal Reserve printing less money. Central banks around the world are increasing interest rates and unwinding some of their purchases. Looking at all of this together, you can see that there has been less growth than we had previously. So all of these things coupled together have been quite accurate to what we have been noticing at this particular time. But it happens to be a very important one. But I want to show you something. Chinese macro policy has become a big bet on US growth as it attempted to replace its credit impulse via the current account. Just hang in there, okay? China tightened credit while the external account surplus blew out. This allowed China to import the aggregate demand that it was sacrificing from reducing credit growth. So they were saying, we're going to export a whole bunch of products to the United States, and that will give us an advantage in a sense, and we don't have to pump out money and take additional risk in the financial system, which they knew about. You know that they knew about Evergrande and the whole property sector. So they said, instead of pushing that pedal to the metal anymore, because we already got some serious risks, we're going to do it in this way and hope that the supply chain doesn't break down, because that's the key problem right now. Looking at all of this, they have been able to be more successful than some other countries out there, essentially doing it in this way. And it is very interesting. So they can risk off in a sense while still pushing themselves and trying to create as much growth as possible. It's interesting to say the least. This comes from the Financial Times, and you could see China credit impulse year-over-year change, just basically the same information. The credit spigots have most emphatically not been turned on. This has been the case, at least in part, because China has had the luxury of importing the demand created by government stimulus in the US and elsewhere. But with its economy slowing down, how long can the government wait. As one longtime China analyst said to me, the contribution of the property sector to GDP growth is just too important to ignore. And with the regular resurgences of the issues going on from 2020, closing down the country every few weeks, not to mention the promises to be a cold winter, I just don't think Beijing has a stomach to keep the property sector down. This is huge. When I say it's huge, I mean it is huge. We need to understand how important the property sector is in China. We got that. The China credit impulse slowing down, levels we haven't seen since 2011, just around that financial crisis timeframe, and of course what happened after that. And then you've got the situation that's happening globally. I mean, coupling everything together, you realize that there is a very serious scenario that cannot simply be resolved overnight. So all of this, I think people should be aware of. And I want to break this down quite simply in the Money GPS Insights. The China credit impulse is by far one of the top indicators that you can look at to determine if a slowdown is coming. At least in a historic sense, we have noted time and time again how accurate it has been. The actions that China has taken has been a very different policy from most other countries, and that has sparked some questions. You as an individual, you could take all this news and all this noise, and you could simply let it slide. But I think the most prudent thing to do is to be prepared for any possible scenario the best you can. Take action today, don't wait until tomorrow. Now, there are certainly risks being taken today, and of course, underlying all of it is the actions of the central banks. This happens to be the balance sheet of the Federal Reserve, and you can see it is over $8.6 trillion, heading on its way to 9 trillion. Maybe we can get to 10 trillion before this is all over with, but I just wanted to give you an update on that. If you want to see the details broken down much more clearly, you can type this into a search engine, Fed H41. If you type that in, Fed H41, you're going to be able to pull up this document. It's dated, so you get the newest one, and you can see it all down to the dollar, looking at all the different details, whether this is coming from the form of loans, the primary credit, you're looking at the repurchase agreements, all these things are all listed on the H41, so definitely check that out. Now, many people said this wouldn't come, but you can see for yourself. This happens to be the schedule for what they're going to do in the upcoming month. And that is simply that they are going to be pumping in $70 billion for their treasuries, buying up treasuries at $70 billion a month rather than 80. They're reducing both the mortgage-backed securities, they're reducing both the treasuries and that. And many people said it wouldn't happen. Here we are today. That's the case. All those details, as always, will be in the description under the sources. Now we're going to talk about what this really means, because, 8.6 trillion here, 8.6 trillion there. You want to know what's going on for you, right? Of course. Well, this is key, real key. Everybody I've talked to in the comment section, in person, everywhere, they have noted how crazy the real estate market has become. The rental market has become, and buying as well. It's all going crazy. And some of these houses that I've noted that are going for multiple millions of dollars are then being rented out. So it's not as if somebody is, just getting in the market. Okay, I need to do this now because the prices are just going sky high. They're buying them and then they're renting them out. It's unusual to see this because you would want to find some semblance of reality if you're going to rent that property out. It's probably not going to cash flow. Anyway, homes now typically sell in a week, forcing buyers to take risks. Buyers are often waiving traditional safeguards in fast-moving markets where the median price has climbed. They're not doing all of their checks. They are not going in and understanding what's happening at this property. Is there any foundation problems? Are there leaks here? What happened beforehand? We don't have time for that. Let's put an offer in today. That's the market's the insanity. If you agree with this, that this is crazy, that this is abnormal, in a historic sense, but just in actual fact, hit that thumbs up. I want to know what you think. Put it in the comments below. Hit that thumbs up to let me know that you do agree with me, okay? This is not normal. Inflation surge whips up market froth. Low inflation-adjusted returns on government bonds is driving investors to riskier corners of the market. I've said that about 12,000 times. This comes out of the Wall Street Journal, however, and it is true because you're in search of yield. Where do we go? They're mentioning Rivian. The stock went crazy on the first few days. The actual IPO, like where it IPO'd at, many said this is ridiculous. Why? Because they've produced something like 125 cars. Okay, what real yields? The amount of return that somebody's getting is basically nothing today if you look at bonds. With real yields, the lower they are, the more it encourages speculation. That's why people have turned to all different types of meme stocks and all these dog coins and everything. It's just far, far gone from reality. Clock ticks closer to midnight for overwhelmed California ports. If emergency fee plan goes forward, the price tag could top $100 million within days. There are big problems here. I've talked about the containers being just thrown anywhere they can. I mean, the problem is just the list goes on and on. This can't be sustainable. Crunch at the ports may mean crisis for family farms as well. The family farms are unfortunately gone. They are becoming a thing of the past because the agribusiness taken over. They've got unlimited pockets and they're able to simply push out all of these family farms. It is quite sad, to say the least. Supermarkets alter layouts and use decoys to fill gaps left by shortages. Product shortfalls caused by supply chain bottlenecks are pushing grocers to get creative so consumers aren't facing empty shelves. An issue I had brought up saw multiple comments saying that I was a liar or that I was reporting false information. It's here in the Wall Street Journal. Take it if you'd like. And then this, I thought it was interesting. Because what's the solution? We've got big problems. Oh, I know, another tax. Now, you might say that taxing the billionaires would be a good idea. I just want to share this. Bernie Sanders says we must demand that the extremely wealthy pay their fair share, period. And Elon Musk, I don't know what was going on here when he said this, but he said, I keep forgetting that you're still alive. I mean, that is just shocking to me when I saw that. But regardless, what I'm trying to suggest here, all I'm trying to say is that if you taxed everybody, billionaires included, 100%, all their income, they would still not be able to pay the debt. The deficits would just continue to get worse. That's how broken the system is. It is mathematically impossible to fix. That's all I want to point out. Right now, the White House spurns Intel plan to boost chip production in China. Like, what's going on here? We've got a problem. Can't get stuff from overseas. The chip maker, Intel, has pitched China investment as a way to ease the shortage. They wanted to have a new factory in China, ship the stuff in. Hey, we're all good. No, we need domestic this isn't working. This is not working. The whole system is not working. It needs to be resolved. One of the big issues I have today is, oh, I get it. Wages have gone up, but in comparison to inflation, what people are paying, and that's the CPI, not even real inflation. The CPI is going straight up. Wages are going up, supposedly. And it's just not keeping up. Look at that. There is a chasm in between these two that will not be resolved by their actions. And then we have this savings being depleted back down to where we were at the beginning of 2020. People don't have that money. And this was all because of the stimulus, the handouts that were being given. And now we could even head lower potentially. All this to say, you must be ready for anything. Anything is possible today. Simply get everything in order as best you can with the means that you've got. And hope for the best, essentially. That's all I have. If you want to support the channel, just click that thumbs up button. It's right down there. And if you haven't already, subscribe to the channel because I bring out content every single day and I've got some big changes coming. All right. If you haven't seen this video yet, you definitely want to check it out. So just click it and I'll see you there.